Hello investors and future investors, welcome to the channel. For today's video, I'm going to be giving you two undervalued stocks. In addition to that, I'm going to show you the option strategies that I will be using in order to use these two undervalued stocks in order to grow my portfolio. One last thing I will do is go ahead and give you a bonus stock that is currently still undervalued that can be used, especially if you're trading with a small account. Now, if you are new to the channel, and especially if you are trading with a small account portfolio, then this is definitely the channel that you want to subscribe to help you grow your small account portfolio. Now, welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's video, I'm going to be showing you two undervalued stocks. Yes, they are undervalued stocks still in this market that has been trending upwards for the longest while. We're going to go over two of these undervalued stocks. I'll give you a step-by-step walkthrough of the option strategies that I'm going to be doing in order to grow my options portfolio with these two stocks, and I'm going to show you my exit strategy as well. Now, you guys know how we do it. We like to go ahead and get down and dirty with options. Now, the first stock we're going to feature today is none other than Novo Nordisk. Now, Novo Nordisk is in the healthcare sector, so go ahead and do your own due diligence before investing in any stock. Now, before I go ahead and jump into the options chain, let's go ahead and check out the advanced feature by hitting the advanced feature right here. Now, usually I like to go over to the 1 year mark in order to check out how the stock is doing. So we're going to start off there and then we're going to proceed. Now, for those of you who do not know, or those of you who are new to the channel, this is my preferred setup. I would trade this setup every single day if I could. The reason why this is my preferred setup is because the blue line here, which represents the 200-day moving average, is above the current share price of the stock. With the 200-day moving average, it simply tells you where the share price has been trading for the last 200 days or the last 6 months. Here's the thing about the 200-day moving average. The 200-day moving average and the share price, they always touch. By using the strike price when it's below the 200-day moving average, you have a high likelihood of the share price going up to touch the 200-day moving average. Now, when the share price is above the 200-day moving average, there's a strong possibility that the share price goes down to match up with the 200-day moving average. So my perfect setup is when the share price is below the 200-day moving average on a good stock. Secondly, what I like about this chart is the RSI, or the relative strength index. You can see that to the bottom here, RSI. Now, this momentum indicator helps us determine whether a stock is overbought or oversold. Currently, the RSI of Novo is around 43, which is good in my books. Now, anything below a 50 RSI going towards the 30 RSI tells you that the stock is going towards oversold territory. So I also like to pick up good stocks where the share price is below the 200-day moving average and it has an RSI below the 50 RSI. Okay, next thing we're going to look for, we're going to go ahead and look for the support. The next level of support is going to be around the 48.50-ish range. Let's go out one more to the 5-year chart to see if we could find a very strong support. So we're going to draw a trend line right here. And once again, that support is right there again around the 49.50 mark. Now, if I go all the way back out here, you're going to see that strong support has been there since around 2021. So it's been a year since the $50 price, the 50-ish dollar price has shown a strong support on Novo Nordisk. Now, how am I going to use this undervalued stock in order to grow my small account portfolio? Well, for that, let's go ahead and go to trade Novo down to the bottom in order for us to open up the options chain. Now, this area down here in its entirety is what's known as the option chain, and this has enough information in order for us to go ahead and make a very informed decision. Now, before you go ahead and go into these option strategies and decide to practice with your portfolio, I need you guys to do yourself two favors. Favor number one, always make sure to do your own due diligence before investing. What may work for my portfolio may not work for yours. The second favor you need to do yourself is always make sure you have an exit strategy. That way, if the trade do decide to go against you, then at least you know how to get out of the trade. And remember, these videos are for entertainment and education purposes only. No one's going to know the best thing for your portfolio except for you. Now, let's go ahead. The option strategy I'm going to be using for Novo in order to grow my small account portfolio, I'm going to go to sell, I'm going to go to put, and now I'm going to go ahead and choose my strike date. The strike date I'll be going with is going to be October 17th, which gives me 33 days to expiration. What I am looking for by choosing the strike date is I'm looking for monthly expirations. So October 17th represents the closest to 30 days as possible. Now, you could also go with the October 10th, which gives you 26 days, and the October 24th would be ideal. But for today's video, I'm going to be rocking with the October 17th. Okay, now we have sell and we have put. Now I'm going to go ahead and choose my strike price. Now we just established that the 50-ish price, it shows a very, very strong support. So what I'm going to do is that I'm going to use that as my basis in order to choose my strike price. So I'm going to be going with the $50 strike price. Now the $50 strike price gives me a chance of profit of around 79.87%. Let's round it up to 80%. So there's an 80% chance that this trade is going to go in my favor. So with the $50 strike price, an 80% chance of profit, I'm going to be paid because I really like to do option strategies that I get some kind of income. That income, what helps you grow your small account portfolio. The amount I will be paid is going to be 0.83 or $83. Each option contract does contain 100 shares. So whenever you decide to do one option contract, you're going to multiply the amount of money you're going to be receiving by 100 shares, and that's going to give you, in this case, $83. Let's go ahead, let's select that. Now, this option strategy is going to be known as the cash secured put. Now, if you guys see the strike prices fluctuating, that just means the stock market is currently open as I'm making this video. So like I was saying, this option strategy is known as the cash secured put, and the cash secured put is a very good option strategy in order for you to use to grow a small account portfolio. Now, exit strategy. What you want ideally is that come expiration date or before, you really want this share price here for Novo to stay above the $50 price. Once that happens, then you get to keep your $83 and then you're going to have your collateral released back to you. That's right. In order for you to do this option strategy, the name is a cash secured put. You need to have a cash to be left in your portfolio in order to secure the trade. That amount of cash is going to be $5,000. You're going to come up with the $5,000 by multiplying your strike price by 100 shares. Once again, each option contract has 100 shares. So that's going to be $5,000. In order for you to do this option strategy on Novo Nordisk, you must have a minimum of $5,000 cash in your portfolio. Now, there's another way that this trade could go. Come expiration once again, or probably before, if this share price here of $55 happen to drop below your $50 strike price that you chose, then once again you're going to keep your $83. Remember, this here is always going to be yours to keep no matter how the trade goes. That is what allows you to grow your small account portfolio, because you keep getting that consistently every time you do this option strategy. So what's going to happen is that when this share price goes below the $50 price right here, you're going to lose your $5,000 collateral. But it's not all that bad, so hold on a second. Now that you've lost your $5,000 collateral, what's going to happen is that you're going to now own 100 shares of the stock at $50 per share. So you lost your $5,000, but now you have the equivalent of the $5,000 as 100 shares of the stock. When doing the cash secured put, one of the most important criteria is to always do it on a stock you don't mind owning in your portfolio. So hence I'm using Novo Nordisk. Novo Nordisk is an undervalued stock right now, which I don't mind owning my portfolio. So if the trade do decide to go against me, then I now own 100 shares of a stock that I wanted to own in my portfolio in the first place at a much lower price than when I actually got into the contract. So that right there is the first undervalued stock that I'm going to be using to grow my small account portfolio. And the strategy I'm going to be using is going to be the CSP, or the cash secured put. Now we're going to go ahead and get into the second undervalued stock and the option strategy I'm going to be using to grow my small account portfolio. Before we do that, if you guys have not already and you guys are getting any value from this video, now would be a perfect opportunity for you to go ahead, like the video, subscribe to the channel. Now, for the second undervalued stock, that's going to be none other than TTD, or the Trade Desk. Now, I have highlighted this stock and I have been trading this stock for a very, very long time. I've gotten in and out of this stock and I've made several amounts of money with this stock. However, the stock is now trading at $45.56, which I think presents an excellent opportunity in order to get back into it. Now, let's go ahead. We're going to jump into the advanced feature to see how it is. And once again, let's start off with the 1 year mark. Now, once again, you guys gonna see this setup that I like to trade where the share price is trading below the 200-day moving average on a good stock, and also the RSI is below 50. The current RSI is around 40 RSI. The share price is below the 200-day moving average, which the 200-day moving average is $81, around there. So now let's go ahead and we're gonna go to the 5-year outlook. But before that, let's get a support. We're going to draw a trend line right here, and you're going to see we have a very strong support around the $50-ish range. So $49.95, $50. So let's go ahead. That's a very strong support. The reason why it's a strong support is that the graph hit this trend line multiple times. Now let's go ahead to the 5-year outlook and see what that looks like. So here we go with the 5-year outlook, and once again, the current price is trading below the 200-day moving average. I'm now going to go ahead once again and create another trend line. And as you can see here, right here, it also creates a very strong support around the 46, 48. So around the 46, 48 price is ideal for this stock. And if I go all the way out here, you're going to see that this stock has been trading around this range from 2022. And if I go all the way left back further, you can see it has been around there from since not 2020 actually. So that's an extremely strong support around the 45, between 45 and $50 range. Now let's go ahead and go back, and we're going to get into the option strategy I will be using. And for that, we're going to go ahead to trade TTD options and open up our options chain. Now, the option strategy I'm going to be using for this particular undervalued stock, which is Trade Desk, I'm going to firstly go to buy. I'm going to go to call. Now I'm going to proceed to choose my strike date. The strike date I will be going for this one is going to be January 15th, 2027, and that's going to give me 488 days to expiration, which is way more than a year. Now, there is a reason why I went out that far, and I'll explain as the video goes along. Now I'm going to go ahead and I'm going to choose my strike price. The strike price I'm going to be going with, based on the information I just showed you with the chart, I'm going to choose the $45 strike price. I did just demonstrate that the $45, between the $45 and $50 range, creates a very strong support. So I feel very confident choosing the $45 strike price as my price to get into this option strategy. Now, because this new option strategy is a buy strategy, I'm going to have to pay. The amount I'm going to have to pay is going to be $13.60. Once again, we are dealing with options contracts here. So remember, you are dealing with hundreds of shares per one contract. So you're simply going to multiply your $13.60 by 100, and that's going to give you $1,360. That's the amount you're going to have to pay to enter this option contract. Now, this option strategy is going to be known as a LEAPS option. LEAP stands for Long-Term Equity Anticipation Securities. It is a mouthful, hence we just refer to it as a LEAPS option. Now, here's a fun fact. If you do one contract, it's going to be a LEAPS option. If you do multiple contracts, it's still going to be a LEAPS option. So now that you have a LEAPS option in your portfolio, what are you going to do with it? This is what you're going to do. It's going to be the hardest thing you've probably ever done in your life of trading. You're going to do absolutely nothing. The reason why you're going to do absolutely nothing is because the whole point of you getting into a LEAPS option is that because you're of the mindset that this current share price is going to appreciate over time. Now, the time factor. The amount of time you actually give yourself is going to be 488 days. So this share price has 488 days in order to appreciate. We did also establish by the chart that the 200-day moving average is around the $81 mark. So exit strategy. What I am looking for is that I'm looking for this share price to go to $55. Once the share price goes to $55, then I'm going to consider getting out of the trade. Now, The way you make money with your leaps option is through share price appreciation, meaning whenever the share price goes up, then your option goes up in value. So my exit strategy is going to be once it gets to $55, I'm going to consider strongly to get out of the contract. Now, I cannot make a definite decision on whether I'm going to get out of the contract right now or not at a $55 price. The reason for that is that if the share price does go to the $55 strike price and the market is trending upwards, then I'm going to let it rock out before closing it. Now, if it does get to the $55 price and the market is neutral, then I'm going to go ahead, exit the strategy, and lock in my investment gains. So there you have it, investors and future investors. These are two stocks in the midst of this stock market that have overvalued prices. These are two stocks that are still quite undervalued, in which I am going to use in order to grow my account portfolio. Now, I did promise you I'm going to give you a third stock that can be used and it's still pretty much undervalued in order to grow a small account portfolio. So let's go ahead to that. Now, this third stock, this bonus stock for you is going to be none other than UNH, which is going to be United Healthcare. Now, as of making this video, United Healthcare did have a trending upwards. Let's go to the 1-year chart. Just recently, over the past week, this share price did move up to around $353. Now, if you draw a trend line right here, you're going to see that it has been trading around the $300 mark for 3 months straight. So, and I have been trading this stock, so I know a lot about this stock as well. So within just 1 week, it's moved from the $300 mark to the $350 mark. And once again, as you can see, the current share price is still below the 200-day moving average. So I'm going to go ahead, I'm going to demonstrate one option strategy that can be used in order to trade United Health to grow your small account portfolio. So once again, let's going to go to trade UNH options. And then now we're going to go to sell. We're going to go to put, and then we're going to go ahead and choose our strike date. The strike date we're going to be using is going to be, let's go down a bit. We're going to be using October 31st, which gives us 47 days to expiration. Now, ideally, when you're doing the majority of option contract, the best strike date is always going to be a strike date that gives you around 45 days to expiration. Now, this is a proven strategy by the CBOE, which is the Chicago Board of Options Exchange, that tells you that the 45-day mark is ideal. And then I'm going to go ahead and explain the exit strategy for this particular trade. So now we have sell, we have put, we have 47 days to expiration. We're going to go ahead and choose our strike price. The strike price I will be going with is going to be the 325 strike price. Let's go ahead. We're going to select that. Now I'm going to go ahead once again. I'm going to go to buy while maintaining put and maintaining the exact same strike date. I'm going to go ahead and choose the next strike price right under my previous price. And that's going to be the 320 strike price. Let's go ahead, select that. Okay, this new option strategy is going to be known as the put credit spread. So right now, although United Health has gone up over the past week, it still has lots more opportunity to run. The put credit spread is a bullish option strategy, meaning once you get into this option strategy, you're of the mindset that the current share price is going to continue to go up. Hence, I'm doing a put credit spread, which is a bullish option strategy. Let's go ahead. We're going to hit continue. Now, if I were to go ahead and do this option strategy, this is another income generating option strategy. The amount of money I would be getting right away is going to be $125. Now, this $125 and this option strategy, the put credit spread, is quite similar to the first option strategy, in which this money you get to keep no matter how the trade goes. Now, let's go ahead and jump into an exit strategy. So ideally, the desired result you want is that come expiration date or before expiration date, whenever you choose an option strategy, an options date of around 45 days, the ideal time, once again, proven by the Chicago Board of Options Exchange, the ideal time to start getting out of it is when 21 days is left on the contract. According to them, that's when you realize the majority of your gains. Now, if you have no idea what I'm talking about, then go ahead and just search my channel for put credit spreads when you're going to get a deeper explanation of what I'm talking about. So, come expiration date or before, what you ideally want is that you want this share price here to go up or stay where it is. All you want is that it needs to stay above your $325 price. Once that happens, you're going to get to keep your $125 and you're going to have your collateral released back to you. Now, you have to leave a collateral for this put credit spread, and it's quite similar to the first option strategy, the cash secured put. The amount of collateral you're going to have to leave is going to be the difference between your spreads, hence put credit spreads. Your spreads is going to be representative of the two strike prices that you chose. The two strike prices, remember, was $325 and $320. The difference between them is going to be $5. So this is known as a $5 wide spread. Remember, we are dealing with options contract. So you're going to multiply your $5 by 100 shares, and that's going to give you $500. So the collateral that's going to be needed to leave for this option is going to be $500, and your return is going to be $125. Now, $125 is extremely lucrative return. Now, the other way this trade could go, come expiration date, if this current share price, 353.65, happens to fall below the 320 mark right here, then once again, and this is the best part about income generating option strategies, once again, you get to keep your $125 right here. But now you're going to lose your collateral. The reason why you're going to lose your collateral is because this is what's known as a defined risk option strategy. So the $500 that you left as collateral, you're going to now lose that. But do not worry, the total amount you're going to lose is not going to be your entire $500. Remember, you did make $125. So the actual amount you're going to lose is going to be $500 minus your $125, which is going to be around $375. So once again, always make sure to do your own due diligence and never risk more money than you're willing to lose. So investors and future investors, for those who have made it to the end of the video, you guys are the future of options and investing. If you haven't already, this will be your last opportunity in order for you to go ahead, like the video, and subscribe to the channel. If you do have any questions about any of the option strategies or any of the stocks highlighted in today's video, feel free to let me know in the description below. Now, until the next video, keep pushing your investments.